what you can see here is that volatility, in as much as we've seen the all-time highs, ATHs in price, we've seen the ATLs, the all-time lows in expected volatility. Now, what we're showing you here in this chart is important, which is, of course, that volatility across an aggregate reading of durations. Now, that's a lot to say, but they're numbers: 30, 60 days, 3 months, 6 months. Across 4 different durations, we aggregate that, and we tell you that volatility has never been lower. Never. Now, across a time series, never is a long time ago because it's never happened. So at the end of the day, never is a long time, in as much as ever is a long time. When we talk about the highest stock prices ever in the S&P 500, the Russell, and the Dow, that was only on Friday. So that's the main reason why the stock market is down this morning, is because we hit the top end of the risk ranges in the Dow, the Russell, and the S&P 500. So again, can these all-time low levels in expected volatility, now what we're talking about, of course, is not only real, we talk a lot about realized, but what that chart shows is implied volatility, which is the expected volatility. It's expected to be at the all-time lows. So can that remain a reality? Yes. What are the 2 big things that we'd be focused on no, i.e. the beginning of the end, which you can read Zero Edge all you want all day long about the beginning of the end. It still hasn't begun. But the reality is that we would be looking for 2 big things. Number 1, we would look for economic growth to slow on a trending basis. Number 2, we would look for earnings season to slow. Earnings season has not slowed. Earnings season, do we have that, Josephine, this morning off the top of the risk management morning? We have a 14.5% start to earnings season, Darius. So that's not bad.
Not bad at all.
Now, if you back out energy, which everybody's like, well, it's all energy. No. There have been 0 energy companies that have reported. That is a number that is X energy. Just wait until energy reports, which will be up a lot in the hundreds of percents year over year because it's comparing against last year's depression. What you'll note is that you'd have to, if you're a bear of the stock market, you'd have to back out tech. That's what you really need to do. You need to back out tech because that's what's driving the number. As you can see there, tech revenues up 16% and earnings up 53%. Admittedly, only 6 companies have reported out of 67, but admittedly, you'd have to admit that the stock market trades on what has been reported. So guess what? Why is tech up 17.5% for the year to date? And why is volatility at the all-time lows? Why are stocks at the all-time highs? Because tech's up 53% earnings currently for the, this is and it's probably going to come down a little bit, but give me a bone here. That is no catalyst for the next bear market, just FYI fundamentally.